Hello, everyone. Thank you for joining us. I would now like to turn the mic over to Robert Kleiman.
Thank you, Laura. And thank you for attending this last seminar on charity in our series. The music we played, "A Bridge Over Troubled Water," is my favorite song, and Simon and Garfunkel I love. But when I joined philanthropy, that song all of a sudden had more meaning to me. Is that everyone on this call, on this Zoom, we're all together working for charity, either it's advisors or whatever, and we help create the bridge over troubled water, help people, whether it's hospitals, universities, however we do it. And so it's great meaning to me. And in particular, and we're all together, I'd like to, on behalf of all of us, offer our thoughts and condolences to the terrorist victims in Israel and all that. And again, acknowledge that we're all in this trying to make the world a better place. And now we move on to our seminar. This is our last seminar. Last week's seminar is not yet on the website, but it will be momentarily. And also many of you have asked for, I asked you to send in questions and also asking for an Excel spreadsheet on valuation of shares, evaluation of insurance and everything. We haven't yet sent it out back to you. It'll happen this week. So just to know that. So today we're talking about a difficult subject. It's just difficult because it's a little more complex and out of many people's norms, and that's private company shares. Private companies are very important. Businesses run in through them because of limited liability companies. Public companies, because they're in a company, you're able to sell shares on the marketplace. So shares and companies are very important to business, and consequently, if they're important in business and that's where wealth is, it's important to charity. We in Canada, there's a plethora of holding companies, different from the Americans, where because we have the ability for an active company to have a parent company and send dividends to that parent company without tax. So extra dollars that you want to reinvest in other ways can move free of tax to the holding company, and then the holding company reinvests. So you have much of Canada's wealth sort of in holding companies. The holding companies may own active companies or a public company, shares of public companies. It may own real estate. It may own lots of things. But we're in North America, we're unique. The Americans do not have that. They don't have the ability of just moving funds up to companies. Personal tax rates in the States can be just as low as the corporate tax rate, so there's no value in sometimes being taxed in a company. Americans have S corporations where they have worked through a limited liability company, but the taxation goes to the individual, and therefore gifts come from the individual. So it's a different system now. And one of the realities in America is that you have succession duties on the value of your estate, which are quite onerous, and charitable planning is part of the solution there. In Canada, we have these companies and other assets are deemed to be disposed of at the second death of a couple, and therefore all the values within these companies get taxed as capital gains at death, and that's proper and fine and everything. But as gift planners, that's sort of something to look at. Where there's that type of things happening, there's usually opportunities. Last week when we looked at insurance, we saw opportunity to do insurance through a holding company to create a testamentary gift. And we're going to look at other techniques today involving private companies. Just to reference two gifts that were in the news in the past year in the States. Patagonia, a major company, but a private company, was listed as the owner had put the shares into a charitable trust. And a few days later in the New York Times, they talked about the tax plan, the plan using charitable remainder trusts and other things in the States, which are much more complicated than Canada, of how that works. And that's why there are so many huge foundations in the United States, because of the succession duties and the movement of these shares into charities. And we saw a wonderful gift in Canada from the Winnipeg Foundation, a community foundation, a brilliant gift from someone's estate, from someone's will, of private company shares of, I think, $500 million. So what a wonderful, amazing gift that was. And what was the planning involved in that gift and in doing it? It wasn't a gift of cash, it was a gift of the shares. We're going to look at those type of gifts of companies and how a charity can deal with it and whatever in this seminar. So I'm going to reference two kinds of gift. We can be on the slides now. Sorry. And we can go to the next slide and then the next slide. So we're going to reference two kinds of gifts. There are many kinds of gifts, but two categories of gifts. So a gift of a private company shares, okay, when you gift it, and the charity receives it, and the shares get bought back by the company immediately afterwards. So here's a share certificate that says 100,000 preferred shares, and the next day the company buys back those shares from the charity now for $100,000. So the charity has converted the paper of a share into cash. So that's one kind of gift. The second kind of gift is, yes, here's the gift of preferred shares, but they're not getting redeemed immediately, and the charity's going to hold them on their books. And, the question is, how is this? How are these accounted for? Now, when we talk about private company shares, generally two kinds. There's common shares, the value of the company, and preferred shares, which is usually a set value. There's all kinds of permutations and combinations, but preferred shares is a set value. It's $100 of value. That's what it is, and you have that. And as we said before, we were deemed to dispose of this on death. So you own common shares of a company that are growing in value, and then at death you're taxed on it. We have estate freezes in Canada and the United States, and where someone says, look, those values of those common shares are increasing all the time. I don't need it. All I'm going to have is taxed on that value. Let's stop that value increase. So that's called an estate freeze, where someone takes their common shares to the company and they say, it's worth $5 million. Let me take back from the company. Let me get rid of my common shares, and the company will issue to me $5 million worth of preferred shares. So they'll always own those preferred shares. That will be a deemed disposition of those preferred shares on death, and you'll have a gain at that time. But the new common shares will be issued for $100 because all the values in the preferred shares at that time, let's say, to the children. And then in the future years, as the company does well and continues to grow, the increase in value in the company will go to the common shares. The preferred shares cannot increase in value. So that's an estate freeze. I'm freezing the value of the estate and to benefit the children. And we have that. So I'm pointing that out because we're going to look at these kind of shares later as potential gifts, and knowing that shares are going to be subject to tax ultimately on death. So luckily, in the next slide, we have detailed tax rules on gifts of private company shares. We actually have detailed tax, more detail there than just about any gift. And why is it such detail? Some time ago, I don't know, 25 years ago or something like that, there was a gift to a private foundation. I won't mention the name, of debt of a company, and finance was, this is horrible, and this is terrible, but it was lawful. There was nothing wrong with it. So they changed the Income Tax Act. This was the same year that we got the public company exemption, the first tranche of that. So they put in the Income Tax Act, they basically put in rules that took away all kinds of gifts from private companies. It was gone. Your associations, the CAGP and the others, law associations of Ontario and others, came back and said, what are you doing? You're giving a benefit to if you have public company shares, but private company, someone owns private companies, they're sort of penalized. So they went back and they established, okay, what's fair here, what's good to do, and with lots of rules to try to say this is okay and that's not okay. And I like that when that happens, when you have detailed rules, because it creates less uncertainty about what you can do, what you can't do. It's not, oh, is this a garble thing where it's against the provisions of the income tax? Well, you have detailed rules of what you can do, what you can't do. It sort of creates a path. Sometimes you don't like the path. Sometimes the path is too narrow by the rules, but at least you have a path that you could follow. So the first rule, and this is the first rule before the exception. There'll be an exception, which is going to help us. So the first rule, it's a basic rule, and I'm putting it in 5 words, is that when you give a gift of private company shares, we'll get to exception, no receipt is given until the shares are monetized. So that's a word we're going to use now, monetized, turned into cash. So that example, the first example of here's a gift of 100,000 preferred shares, and I'm giving the gift on today's Wednesday. There's no receipt on Wednesday given. On Thursday, the shares are monetized, turned into cash. On Thursday, I issue a receipt. Okay, so that's the basic rule. Okay, and that's very good, and we have that. So it confirms that you can give private company shares and monetize, and you get a receipt, and it's cool. Of course, the second category of gift that I showed was one where you're not getting it redeemed, monetized right away. That catches all of that, right? But there's exceptions. So the exception is if the gift is to a public charity. So public charity is to, a basic charity or to a public foundation, donor advised fund foundations, public foundations, not private foundations. So that's clear, not a private foundation. So that old court case in which this gift was made to a private foundation, well, that would be out there. They were saying we don't want that. Okay. And if the donor's at arm's length with the charity, you have an exception to the rule. You can give a receipt and you don't have to wait for monetization. Now, so what does it mean being at arm's length with a charity? So there's general rules of arm's length. Yeah, do you control the charity somehow? If you're, one can say maybe if you're the biggest, you're the biggest donor and you give 85% of the money to that charity every year, and you have and you tell them what to do type of thing, one can claim you're not an arm's length. But the basic definition in the Income Tax Act is clear, and it's are you on the board of are you an officer, board member of the foundation charity? Okay, so if you are, and if your relative is, if your father is, your child is, or whatever, well, then you're not at arm's length with the charity, and therefore you do not get the exception. And we need the exception for many gifts. Okay, so what you have in reality when this situation arises, a gift where the shares will not be redeemed the next day, and you want to issue a receipt today, and you look in the planning and you see the person's a member of the board of directors, is they resign. Yeah, if they want to make that gift, and they're off the board, and so that they have arm's length status. And if you look at the technical rules, we're not looking at this. There's 5-year tests and things like that, so a person can get back on the board in 5 or 6 years later. But I'm not going through all those technical little rules. This is the basic rules, and this is good enough. Okay. Just another few things about shares, not on the slides, is that you have, there's a rule for public foundations that say they cannot acquire a control of a company. So what happens if you're gifted shares, which are voting shares, and all of a sudden, by virtue of votes, you control the company? So we create a difference between a gift and acquiring. Acquiring is I'm going and getting them, I'm buying them, I'm going and getting them. And acquiring control is I'm receiving. Sorry, acquiring is going and getting it, and getting a gift is receiving the gift. So we differentiate between the acquisition and the reception of a gift. Okay. So we say, if I'm given a gift, I'm not acquiring. I'm not going out and getting it. I'm receiving it. So that viewpoint has been the viewpoint that we have seen for decades on that rule, which means that we can accept. We'll see later in the seminar. We accept the gift of a whole company, which will be wound up and everything, but we can get a gift of a whole company, and no problem. We control it, but we're going to wind it up, of course, and move the assets into the charity. But we can do it. Another little technical thing, just again, not particularly with the seminar, is that for private foundations, you cannot own, and there's more detailed rules than what I'm telling you, 20% or more of any share class of any company. And that stops, private foundations from owning, Microsoft. Gates Foundation owns, has shares of Microsoft in vast quantities. I'm not saying it's 20% or whatever, but I'm just saying it stops the American experiences. They can move, all these Patagonia as before into a private foundation. You can't do that in Canada. A private foundation, if you have 20% or more, and they look at related ownership, there's a penalty for every month that you own those shares in the thing. So it's a bad idea. And by the way, there are some investments that are made. I said this before. Hedge funds in Europe, the investments are in the form of common shares. In other words, your investment is Class X common shares. Another person invests Class Y. That's how you hold the investment. Can't do it in a private foundation. But that's just another little tidbit on shares. Okay, so next slide. What happens to the donor by the gift? So when you give a gift of the shares, you're disposing of it. It's not a real disposition. You're not selling it, but it's a deemed disposition. We have deemed dispositions on death. You're deemed to dispose of your assets. When you gift shares, you're deemed to dispose of it. Okay, and you're deemed to dispose of it. You have a disposition. Your proceeds of disposition are the value of the shares. Okay, and your cost base is your cost base. So by making the gift of private company shares, you can have a capital gain. Now, often do, unlike public company shares, where we have the beautiful exemption. Now, it doesn't mean you will have a capital gain. You may have a full cost base. You may have shares that have full cost base, super capital gain exemption shares that resulted in full cost base. So there are different things that say, you might have cost base, and then we're going to look at an example of that later. Cost base, full cost base, and there's no gain. So you can have that. Now, I said the proceeds of disposition will be the value of the shares. So because it's not a cash gift, you need a valuation done. So, independent valuator does a valuation of the gift, right, of the shares. And, a letter is sent, a report is sent. In our opinion, the value of the 1 million preferred shares of company Y gifted to charity B is $1 million. And here's why. So you need the valuation, and that sets the receipts, of course, but also the proceeds of disposition, that amount. Okay. There is an election in the Income Tax Act. Okay, I guess where else would it be? Where you gift capital property like shares, and other capital property, where you can elect effectively what your proceeds of disposition will be, anywhere between the value and their cost base. So if you don't want to gain, you can say, and let's say you're gifting 100,000 preferred shares and worth 100,000, and your cost base is $10,000. You can say, I elect that my proceeds of disposition will be $10,000. Therefore, my cost is $10,000, so I have no gain. the other part of it is the receipt that you use is limited to $10,000 in. So you can elect anywhere between $10,000 and $100,000 to be that point, which will create different proceeds and different receipt. Now, a receipt is 100 cents on the dollar, and a capital gain is 50 cents on the dollar. So it's rare that you will ever do it. We used to have this election much more when we were limited to decades ago 20% of your income for charity. So if you made a gift of X amount of dollars, and you saw, oh, I've got a receipt of $2 million, but I can only use the receipt of $2 million against 20% of the income. There's $1 million of capital gain. 20% of that income is $200,000, and I have other income. Whoa, boy, I'm going to have a gain showing a gain of $1 million, and I'm going to use a receipt of $300,000. I'm paying tax. So you had the ability to make this election where you want with the rules that pushing donations to 75% of income, and an additional rule which allowed you, when you gift property to a charity, that you can go from 75% to 100% of the gain to use a charity receipt against that gain. There was very little reason to use this election. However, as you attended our seminar at AMT, and we went through some examples of gifts of shares of companies, we may be no problem on our basic tax return with the use of receipt and with the capital gain. But if we have AMT coming out of our whatever, and we have millions of dollars of AMT, someone may say, well, hold on a second. Are we getting back the AMT? Not so fast. Well, let's look back at this gift. And I mean, some people may reduce the gift, but let's look back at this gift and say, how do we change up the tax here? Well, maybe we make an election at a certain point, which will reduce the proceeds, reduce the gain, reduce the receipt, and maybe say, okay, we won't have AMT. That's part of the future type of thing. So let's look at the next slides. Let's say we've given $100,000 of shares, preferred shares, and redeemed for $100,000. Okay, so we made the gift. We had $100,000 capital gain. We had $50,000 taxable capital gain. We have $100,000 receipt. We'll use the receipt against the capital gain, $50,000, and again the rest of the receipt against other income, saving, let's say, $25,000 of net tax. Okay. But what is the effect of the redemption of the preferred shares? So we talked about the monetization. So if the proceeds are $100,000, so that's easy. So what's paid up capital? Paid up capital is what the shares are shown on the balance sheet. So if one has bought the shares for $100,000, then they're going to show up on the balance sheet as $100,000. It'll say preferred shares $100,000, and then when they're redeemed, the proceeds over the paid up capital, the same $100,000. Okay, there's no effect. There's no effect. There's no tax effect there. Okay. On the other hand, let's say in our state-free situation where we've converted $100 of common shares into $100,000 of preferred shares. So those preferred shares that have been issued, replacing the common, will still have the old capital, $100 of the common attached to the preferred. So when they're redeemed, and you had proceeds of $100,000 and capital of $1 or $100, the difference is a dividend. So in your example, we're showing proceeds of $100,000, $1 is the paid up capital, and there's a dividend of $99,999. Okay, so that means that the company's redeemed the shares, so we've monetized. They should issue a T5 slip to the company at the end of the year saying you've received a taxable dividend. Okay, we know the charities don't pay tax on it, but it's a taxable dividend. Okay, so and that's the tax effect. Does that have any particular meaning? It might to the company because in corporate situations on investment income, the tax rate is very high. They don't want you to have to pay a low rate and defer tax. So they let's say tax you at 50% in the company on investment income, but they say, well, we can return, let's say 28 points out of the 50 or 26 or 28 points out of the 50 to you. When you declare taxable dividends to the company, to the shareholders, of course, then the shareholders will pay tax on the dividends. Okay. So we can give back to you some of the tax that we sort of pre-charged you. And that's called a dividend refund. And do you have the ability to get a dividend refund? Do you have a balance called refundable dividend tax on hand? So it's the refundable dividend, that tax that's on hand waiting for this potential dividend refund. And if you do a taxable dividend, you're entitled to the refund. So here we have a $99,999 dividend. It's a taxable dividend. Well, according to the computations, you will get a dividend refund. It's just computations, and dividend refund could be, $39,000 of this. So that's a good comeback to the company. There is some confusion of it, not confusion. There's some law in the Income Tax Act that says if you're doing something and creating something with the intent, one of the main reasons you're doing it is to create a dividend refund, okay, then we can negate the dividend refund. So you're saying, well, okay, look, I'm giving a gift of redemption of preferred shares. I know the intention was to make a gift. I'm getting a dividend refund, but that's just a byproduct. There was no intention. Now, I wasn't trying to do this. I wasn't trying to do this transaction for one of the main purposes to get a dividend refund. I was doing this to make a gift. You'd say, I shouldn't be caught by this, and I think you shouldn't be. But there was about 3-4 years ago, and probably before COVID, so it's probably 7 years ago, there was a document that the CRA sent out about an estate that had gifted preferred shares and redeemed the shares by the charity, and a dividend refund resulted, and they negated the dividend refund. And they said erroneously, if you make a gift to a charity of shares and have it redeemed, there's no dividend refund. I can accept that it's possible there's no dividend refund, but the rules in the income tax says it was what was one of the main purposes. Okay. And so actually a letter came some years later that sort of reiterated that you have to look at the purposes and all that kind of thing. But it does create confusion. And in your planning around this, you may see a dividend refund arises, and the professionals around the table say to their donors, look, we're claiming the dividend refund. It's ours, but maybe we'll have some difficulty. If I see, shares that, and we certainly do this. We get gifts of shares and they get redeemed immediately. And if it's, a huge amount and there's a big dividend refund, you might say, do the redemption over a period of years. So that it's not in your face that you're getting it all back type of thing, your dividend refund back. Again, that's not great tax advice. I'm just saying sometimes I've cautioned people to do that. So let's look at the next slide, and we're just going to go through some more math. Mrs. A gives $100,000 preferred of A company to charity. Cost base is zero, paid up capital is zero. A company redeems the preferred for $100,000. Mrs. A realizes a capital gain of $100,000, taxable $50,000, gets a receipt of $100,000, uses the receipt against the taxable capital gain of $50,000, uses the other part of the receipt against other income, saving $25,000 of tax. If the dividend refund comes to the company gets back $40,000. Okay. Well, so you've got $25,000 of value personally, $40,000 coming back to the company. So as if the company is costing them $60,000 to make a gift. Let's go to the next slide. And so the company's costing $60,000. That's the cost to the company of this gift. But Mrs. A is up $25,000. So it's a corporate cost of $60,000, but a personal gain of $25,000. What would it cost the company to get Mrs. A $25,000 in the normal course? Because that's what's happening here. They'd have to declare a dividend. That dividend, of course, would be subject to the dividend refund, but they declare a dividend of $40,000. Mrs. A would pay $15,000 of tax to leave her with $25,000. So from the point of view of the company, getting Mrs. A $25,000, they're used to doing that. They're saying, well, our net corporate cost is $60,000. We would normally paid a dividend of $40,000 to get Mrs. A 25. Here she's getting 25 without that dividend. So our net corporate cost of the donation is $20,000. So just a different way of thinking, of looking at these things. So continuing, next slide. Okay. So okay, so we've looked at redemption of shares and the attributes and all that. Now we're looking at the next one where we don't redeem the shares. So here, Mrs. A donates $100,000 preferred of a company to charity, and there's no cost base, there's no paid up capital, and all that things. And instead of having them redeem, we're just throwing this out. A company will pay a dividend on those preferred shares annually to the charity of $4,000. So it's like an investment that the charity at arm's length with the company has, and it's receiving a $4,000 dividend. The reason why I'm saying this, we'll see later, but just to show you the example. So what are the tax attributes there? Well, to Mrs. A, it's the same thing. $100,000 disposition, capital gain, use the receipt of $100,000, save, net $25,000 of tax. A company pays out a $4,000 dividend. That's certainly a taxable dividend. That's not a redemption of shares. It gets a dividend refund of 40%, $1,600. So from the cash flow of the situation here is that Mrs. A, in this example, I'm showing the cost base and the paid up capital is full $100,000. So Mrs. A just gets a receipt, has $50,000 of tax savings. You're out of pocket the dividend really from a cash flow, but you're getting back a dividend refund of $1,600. So on a cash flow basis, by making this gift, you're up $47,600 of tax savings and the net dividend. So it just shows you the power if you're able to make a donation and not have it redeemed, pay out an investment return on it, that the cash flow to the participants are quite positive. So let's move to the next thing. So we've looked at the two share. I'm going to look at that gift in more detail. So now we're going to talk about estate planning of. So what if Mrs. A, elderly person, okay, has common shares of ACO, $5 million value. Inside the company, there are marketable securities with growth and everything there. Cost base zero, $100 or zero, and the refundable dividend tax on hand, that account, which is potentially subject to dividend refund, is $500,000. And that's a typical situation of the people. They're not taking out taxable dividends. They don't need it. They have RIF income. They have other things. They don't need to pay tax on dividends. So the company just grows in value. It pays tax on investment income at 50%, and then has that refundable dividend tax balance keep on growing. So this person has RIF income of $250,000, other assets of $3 million, and maybe has income of $500,000, $700,000. So just different things that are there. When she passes away, okay, second death, she's a widow, deemed to dispose of her assets. So the $5 million, zero cost base, will be a capital gain, $5 million, $2.5 million taxable, assuming a 50% tax rate. She'll be paying. The estate will pay $1,250,000 of tax on that. Okay. So we're asking the question: what if Mrs. A donates 20 common shares? She has 100 common shares. 1/5 of her 100 common shares she's donating. What happens to the hospital? Okay. So here it is, $1 million of value. So, okay, there's zero cost base. You're deemed to dispose of those shares for $1 million. You have a $500,000 capital gain, $1 million receipt. The net that you'll save from the receipt is $250,000. In other words, $500,000 of the receipt will go against the capital gain. $500,000 will go against her other income. So in 1 or 2 years, she can use up that receipt. If not in the first year, she can carry forward the unused balance of the receipt to the second year or to the third year, but she'll be saving $250,000 of tax is the assumption. Okay, that's a good thing. Again, assuming here we're saying we're going to redeem the shares over 5 years, okay, and get a $1 million of donations over 5 years, and over 5 years get $400,000 of dividend refund. Okay, here we have a balance of RDTOH of $500,000, so $400,000 is okay. We're doing that. The other saving to them is that 20 common shares will not be taxed to death, right? It's not there, right? The company doesn't have $1 million anymore. It's worth $4 million. So you would have paid, on that $1 million of value, 500,000 taxable gain, you would have paid $250,000. So just looking at the math here, we saved in the year or in a couple of years, 250. We've unlocked dividend refund, perhaps of 400,000, and tax saved on death of $250,000. Well, that's a $900,000 of value on $1 million gift. So, and it's constantly looking at elderly people who are ready to make donations, and they possibly say, "Yeah, I'll do it on death." You don't, you can do it while you're alive. It's not going to the difference in you don't need the money. You're not using those share, the value in the company. And why not do philanthropy today? Why not start it? Do that program at the hospital. Make things happen. Make the world a better place today. And with a good plan. So we're going to look at the same Mrs. A, same example, the next slide, except we're not going to look at a gift of shares. We're told that the company has a lot of marketable securities. That $5 million is full of marketable securities, and we're told that there's $500,000 of BCE shares with a cost base of $100,000. Great gain. So what happens if the company, and we talked about this in our seminar on capital gains, right? Marketable securities. What a great gift. Okay. Let's say we're donating $100,000 of BCE stock to the charity. We have a gain of $80,000. We're deemed to dispose of it, but there's no tax because it's a public charity. So we are sort of pleased with that type of thing. We're saving tax in two ways. One is the $100,000 receipt. We presume that there's taxable income in the company, investment income, and you can use a $100,000 receipt against investment income at 50%. So you're saving $50,000 of tax on that gift. But the capital gain, we compute this, we're saving tax on $80,000 of gain that we would normally have on BCE when we sell it. So if it's $80,000 gain, $40,000 is taxable. We pay 50% on that, $20,000. So we're actually saving, in some way of thinking, $20,000 plus the $50,000 from the basic receipt. So the company is saving $70,000 or has $70,000 of value. Okay. But that's not the end of the game. Okay. As we've said on gifts of public company shares, one of the great values is that the full $80,000 of gain goes into the capital dividend account, and we can elect dividends out of the capital dividend account free of tax. So now we will move $80,000 tax-free dividend to Mrs. A by virtue of this gift. It's not the same money as the gift; it's separate dollars. So there, you put $80,000 into your hands. And again, as we tried to do the calculations before, what is the value to the company of having tax-free money? If we were going to pay out a dividend to Mrs. A, we'd have to pay out a dividend of $140,000 to get her $80,000. So all of a sudden we're saving. Here we're paying out a dividend of $80,000, not $140,000. We're sort of saving $60,000. Okay, that's like Boolean algebra. Who can really understand that? but that's the savings. But my point here is let's look back at the estate. We started with a company worth $5 million, which we're going to pay tax on. By making the gift from the company, forgetting the tax effects, we're removing 100,000 of value. The BCE, it used to be part of the value of the company, is gone, 100,000 of it. So we're now worth $4.9 million. And then because of the gift and the capital dividend account created, the $80,000, we will pass out the dividend. Okay. She could loan the money back to the company as a loan, but we will pass it out. But that's a distribution. The company's not worth. We started at $5 million. We made the gift $100,000. It's worth only $4.9 million. Oh, we made an $80,000 dividend. Well, now the company's only worth $4,820,000. So we've reduced the value of the company by $180,000. Not exactly, there's tax savings and other things, but $180,000. So if we were to pass away, instead of paying tax on $5 million, we'll pay tax on $4,820,000, saving tax on $180,000. The tax on that is $45,000. So here's another way of looking at estate planning and doing it. So we just seen two ways. Okay. Now, the next slide says, ask the question, well, what should we do? Should we give the gift of preferred shares by Mrs. A, or should we give the gift of Royal Bank shares, BCE shares by the company? And the answer is do both, whatever works. Maximize the tax savings to Mrs. A for her RIFs and everything else like that with the gift of preferred shares. Maximize the tax savings that you have in the company. This is your taxable income. Let's gift so that we don't pay tax on our current tax. So you can hit it from both sides of the equation and play both sides. With the net result is that you're beating down estate taxes from two different ways, okay? And you're doing gifts today. So that's the advantage from the charity's point of view of talking about these things, is that with your donors that care about you, it's that you're bringing them to a level where they're unlocking their assets for you, and they can do it today much faster than saying, oh, I'll do it at death. But they can start doing it today because they see it's part of a total plan, which is quite beneficial to their entire situation. So which is better? I like both of them. I love the gift of public company shares of a company because of that capital dividend account. The only caveats we have now of our two examples is that the part that deals with the individual making the gift of preferred shares and all that, and having a capital gain and a receipt and all that, we have this AMT again, and so we have to new calculations by professionals are going to have to go into this stuff. Yeah, if we're talking about $100,000 gift, it's probably not an issue. But if you're talking about $5 million gifts, yes, it will be an issue and a negative for us in the charitable field. So now we're going to look at a plan, which we sort of touched on earlier in the seminar. And we call it second type of gift. So it's a gift of fully paid shares. So here we've talked about gifts of, estate planning ones where you've converted your common into preferred and you have low cost base. But we've showed that if you give shares with a full cost base, you won't have the capital gain. So we can go to the next slide. And here's an actual plan. Okay. A company. And again, companies are the ones that own assets, and they've sold the business. They've sold stuff. And the company, Taxco, the one with the tax issue, has a $20 million gain. So picture that. That's good. That's good news, right? Has a $20 million gain. So half, 10 million is taxable, and 10 million is not taxable, right? So the 10 million that's not taxable goes into the capital dividend account of the company, and that's where the owners will be removing money via the capital dividend account for years with that capital dividend account, the value of the capital dividend account. That looks at that and says, okay, what are my aims here? Well, I want to do major philanthropy as a result of this wonderful monetization event. I've been blessed and I want to give back. Okay. I want to reduce my tax bill because I don't like paying tax. But also I'm an entrepreneur. This was an investment and I want to reinvest a lot of this money into new ventures, and so yeah, I'd love to make these a big gift, but I have plans for that money. Okay. So you want to do major philanthropy, you want your tax bill reduced, and you want to be able to reinvest your money as much as you can. Okay. So this is the plan. There's another company in the group. Okay, it could be a parent company of Taxco, a subsidiary, a sister company, another company that you own. Okay. Call it BCO. Now, you say you want to make a donation. For tax purposes, what is the greatest donation you can make for tax purposes in the year? So if your taxable income is $10 million, you can make a $7.5 million donation. Okay. If you can make an $8 million donation, but you'll have to carry forward $500,000 of use of that donation, which is what you might do. But $7.5 million is the number. Okay. So Taxco takes $7.5 million. Yes, it's money. It just got $20 million, and invests in its sister company, BCO. It says, here's a check of $7.5 million, and I'm buying preferred shares in that. So one company will buy preferred shares and another company will buy $7.5 million of preferred shares in that company. Taxco, next step, says I want to make a donation. It goes to the public charity, can't do it to a private foundation because we're not redeeming the shares, right? Goes to a public charity, hospital, there's United Way, a donor advised fund, a public foundation, okay? And says, I'm making a donation to you. Here's the donation. It's a piece of paper that says 7.5 million preferred shares of BCO. That's my donation to you. Okay. The charity says, thank you. And says, what do we do here? How do we, what do we issue a receipt for? Well, we have to get a valuation. You have to get a valuation for us to say what the value of those shares are. We don't know what the value is. So generally, let's say the accounting firm evaluated will sit and say, in our opinion, the shares, the gift of $7.5 million is worth $7.5 million. The reasons for it is, well, we see the shares are redeemable, retractable. That means we can pull out the money at our wish. So that's very positive, be able to pull out the money at our wish. And the company, the sister company, has got loads of assets, not just $7.5 million that got put in, but more, so that even if there's a potential loss of investments, we're still got our value. So we're not taking discounts because the company's just worth $7.5 million. That's sort of precarious. No, the company's worth $15 million. And therefore, we're very satisfied with the value of those preferred shares and whatever. And by the way, there's an attribute to these preferred shares which make them really also valuable. And that's the dividend rate. And it's not just a dividend rate of 4%. It's a cumulative dividend. What's a cumulative dividend on a share? It says you have to pay these dividends before you pay any dividends on a common share. Well, what if you don't pay on the common share in the year and you don't pay the preferred share dividend? Well, next year, before paying the common share dividend, it accumulates. There's 2 years of dividends that you have to pay preferred shares. So it's cumulative. That's the term. It's a very powerful, very valuable. So all that, they say this has got value. Now, so let's assume that the share attribute says 4%. Doesn't have to be 4%. 4%, I'm saying, interest rates are going up. That's a good market rate today. Dividend rates are usually lower than interest rates in the market. So if interest rates are 5.5%, 6%, 4% is a good dividend rate, a market dividend rate. So it's sort of market. level. That's part you're doing the valuation market level. If you would have done this a few years ago when interest rates are lower, the cumulative dividend could be 3%, could be lower. But here it's there. But it doesn't have to be 4%. It could be 5%. It could be 6%. It could be 7%. So that's where I'm making a gift to I'm making an example here of a hospital. We're going to pay 5% dividends out of BICO. And 5% on $7.5 million is $375,000. That's going to pay the program, right? Alternatively, right, the hospital takes in $7.5 million of cash invested and takes 5% out for their program. Okay, so here the 5% will come from BICO as a dividend. So BICO will pay $375,000 every year. Will be entitled to a dividend refund. It's not a redemption of shares; it's just a dividend. And it could, assuming it's earning investment income and its investments, it could get back 40% of it by $150,000. So it's a dividend. They're not getting a donation deduction in the company, but it's getting back $150,000 of dividend refund. So it's sort of getting a return because of the donation. And the money is being used for charitable purposes, the hospital, the university. If it's in a donor-advised fund, then your charity will get paid out from your fund because that's your income from your fund, and you can make charity. So that's a tremendous plan for entrepreneurs who's realizing gains and saying, what's happening here? One, I've saved a receipt of $7.5 million has saved me $3.75 million of tax. One thing, objective A done. Actually, that was the second objective, reduce tax bill. I want to do major philanthropy. Well, I'm doing 5%. I'm supporting the hospitals, doing philanthropy through donor advised fund, major way, $375,000 a year. I'm created my annual giving mechanisms for that, and I'm a major philanthropist. I'm happy about that. And as an entrepreneur, I'm reinvesting the money, but you've given the gift of the shares. No, but the cash is in company B. You're reinvesting. You're doing stuff. You're making more money, so that, in my eyes, so that you can make more donations. So it's really together on that. Just look at the next slide. Now, the charity owns the shares. It's their shares. And those shares will be redeemed somewhere. Okay? Not tomorrow. But so some people has a schedule. You know what? I'm going to redeem $750,000 a year of the $7.5 million over 10 years. People have a schedule of that. Some people don't redeem, but they see, let's say if they're doing this to a donor advised fund, they say, you know what, the hospital is asking me now 2 years for $2 million. I've put $7.5 million of preferred shares with you. The donor advised fund, I'm going to redeem $2 million of shares, put it in your donor advised fund, and then send it to the hospital. So that's another way you can do it. And then others say, you know what, I'm prepared to do this, as part of a plan at death. When the couple dies, we'll redeem the shares to clean up our estate. So you don't have a charity owning shares of the company. Then $7.5 million will go to the hospital, will go to the donor advised fund for the family, or go to the hospital and that's the circle. So some people, when doing this, have said, you know what, I'm going to buy an insurance policy of $7.5 million. Okay. They say, I just saved $3.75 million. I'm willing to invest $1.5 million, $2 million of those savings into an insurance policy. I'm making up making this up. So the company buys an insurance premium and of 7.5 or a policy of $7.5 million, let's say invest $2 million over time in premiums or whatever, gives back some of those savings. And at the last to die, let's say the company is going to get $7.5 million, uses the cash to redeem the shares, keeps the capital dividend account from the insurance policy for estate planning purposes. No, it's nothing to do with the charity. So it saves estate tax there using the capital dividend account, which is created, and has a full circle. So if you do the full circle there, you say, okay, I'm saving $3.75 million of donation now. from the donation receipt now. I'm giving back $2 million of that into the insurance company. So I'm sort of up $1.75 million. I'm paying out my annual donations. Okay, that's whatever, getting a dividend refund, but that's my donations that I would do. And at the end, the $7.5 million goes back from the insurance proceeds back a circle, and you've actually done a very sound financial structure and great donation structure for that. So this gift has been around in Canada for a long time. Very clear. CRA looks at this. Hey, is there charity being done? So if somehow no money is getting to the charity, let's say no dividends, nothing is going to the charity, then they're saying something's upset here. Never mind the rules that allow you to do this, but there seems to be a finagling here of stuff. And I know there was a case out of Vancouver of someone doing some kind of thing, and nothing ever went to charity, and they bopped them on the head. But again, so you're going to make those dividends, you're going to do it, and you're going to do charity, and that's great. So next slide. I actually talked about it before. I said, maybe sometimes you can gift the entire company, right? So if you have a holding company, a holding company that you're sitting there and you're saying, you don't need it. You want to make a gift. So here's someone, we have a new Holocaust museum that's going up in Montreal, and a friend said, I want to make a major gift there. And he's sitting with a holding, and we're looking at how he should do it. He's sitting with a holding company he doesn't care about. And he's had about $1 million of value in there. Oh, gift the holding company, get it off your estate. You'll get, as we saw, tax savings personally, and all this kind of thing. We've done this with a more elderly person who just said, yeah, I want to get rid of it type of thing, set up my philanthropy for today, and went to different institutions, the money today, and some on death. So it's there. So you gift the entire company. Now the charity owns it. You do all of the the receipts and everything, and you work all that. Then you have assets in the company that doesn't. The charity has now a company that pays tax, right? Just because it's a charity that owns it doesn't mean it's not taxed. So you want the assets out into your charity. So you're going to wind up the assets into your charity. But what if some of those assets, like in Mrs. A's company, is BCE shares with a big gain? If you're going to wind it up into the charity, there'll be capital gains in the company. So before you wind up, the company gifts the BC and all the marketable securities with the gains into the charity before wind up. It's not about getting the receipt. You don't need the receipt. It's not about the receipt. You're doubling up a receipt. You don't need that. You don't want the receipt. It's just that you're able to make the gift from the company tax-free because it's marketable securities, and you're getting it into the charity. Okay, what's left in the company? There's $500,000 of cash. Okay, wind up the company into the owner, which is the shareholder, the charity, the hospital, or whatever. And now you've got the asset, the $1 million assets of the company, 500,000 cash. You've got the marketable securities, which you sell, and now you've got your $1 million whole and within the charity, ready for use for good purposes. So even this type of thing of looking at that is a way of doing this. So just a couple of questions that have come up. What foundation received the $500 million in shares in a bequest? It was in the newspaper. You can read it. It was a Winnipeg Community Foundation. Who is qualified to value shares here? Well, valuators are qualified. They get a degree in this. Often accounting companies have evaluators in their staff, and so they're qualified to do that type of thing. And because they know the company, it's easy for them to do the valuation. Again, it's usually preferred shares. You're not valuing an active company. What's the value of that? It's sort of what's the value of preferred shares, which has got a set value. It's not that difficult, but valuators, there's a valuation degree, and often accounting firms have people with that degree, and they do that. So those are the two questions. So I guess the conclusion and that we make is that shares are Canada's charitable frontier. It's sort of a little bit like the Wild West, and over a lot of those expressions and everything. It's sort of wild. It's a little. We're unsure of where we're going. We're going into a new land, and what's the geography going to be like? What are things going to be like? It's a little bit unknown. It's a lot easier to receive a gift of $1,000 of cash or than marketable securities, but it is a frontier for people and for estate planning, for looking at their assets. The money's in there. So whether you're working on companies making the gift, which has effect, or you're actually making gifts of shares, it's really important. And the frontier and lots of growth in the charitable industry in this particular way. So, the only issue that is this new AMT stuff. And as we end the series of lectures, we go back to that first lecture. We had that panel discussion at AMT and showing how onerous this could be on givers like Mrs. A. And we showed other examples there of Mrs. A donating an apartment building and the gross AMT, which is going to result from that. And there was a call to action in that seminar that if you believe in this, that this is a problem, is speak to your MP about it, whatever, make a call, do a letter, and just saying, make them aware of this type of thing, because some people say the effects aren't that bad. That bad is a relative term. Bad is relative. It's not going to be good for charities. It's not a good provision. It's bad. How bad? That's something else. So I appreciate you attending these seminars, and hopefully we've gotten somewhere. We have our Ask. We have our Ask Bobby, so more questions and everything and responds for this type of thing. And so thank you. And I thank you for Pear Tree to sponsoring these seminars. As in their way, they look at these seminars as saying, we work with the charitable community, and this is our gift back to them of their association with us, of providing information on this. This is in their small way. This is me doing this. Too bad. Saying we want to get back to the industry and to the charity industry, who are our partners, and by doing this.